Good morning. Good morning. Thank you all for coming and for being here today. I really appreciate all of y'all being here, whether it be virtually or in person. Uh, First off, I want to thank Greater Community for allowing us to have this event here. Want to thank Pastor Taylor and Lady V for allowing us to be here as well. And so I'm Ivan. For those that don't know me, I'm Ivan Lee. I also have my business partner here, Sandra Williamson, and I'll introduce her a little bit more later. But we're here today to talk about life insurance. So September is Life Insurance Awareness Month, and life insurance is very important. It's important in building your financial wealth. And so just really want to educate as many people as we can on that. So just a little bit about me. I'm originally from Chattanooga, Tennessee. Born and raised here, went to CSAS, Chattanooga School for the Arts and Sciences. After graduating there, matriculated to University of Memphis, where I got my bachelor's and my master's degree in accounting. And then after graduating from there, I also got my certification, got my CPA certification, or my Certified Public Accounting certification for the state of Georgia. And then after that, I moved to Atlanta to work for a public accounting firm called PricewaterhouseCoopers. Worked in the audit practice there for 2.5 years, and then moved on to another job in real estate, and I currently work there for Rangewater as a senior accountant. So in addition to that, I also do some accounting and some bookkeeping on the side as well for individuals and business owners, and then also some individualized tax returns as well. So those are services that I offer. In addition, today I'll be focusing on my life and health insurance license and what I can do with that, whether it be, getting life insurance, getting health insurance, or even investment opportunities for people as well. So that's a little bit about me. Can you turn on the slides? And we can go on and get started. All right, so again, welcome. Thank you for coming. As I said before, September is Life Insurance Awareness Month. So why life insurance? That's basically what we'll be talking about today, and the importance of it, and kind of background behind it as well. So you can go to the next slide. So here's a little disclaimer. Our presentation today is not interpreted as accounting, investment, or legal tax advice. If you do want some accounting advice as a CPA, I can give you that advice. That's separate from this. So I won't be giving any accounting advice in this setting, but I can if you see fit to do that. And then also our program is for educational purposes, for financial literacy, so on and so forth. Just want to give that disclaimer out there. So you can go to the next slide. Okay, so a little bit about why we are promoting Life Insurance Awareness Month. So Sandra and I partner with this company called World System Builder, or WSB. And so we have a financial literacy campaign where we're looking to educate 30 million people by 2030. And so it's a big organization. We have a lot of people that are committed to this. And so we offer a lot of different things. We offer financial literacy workshops on a daily basis, and we'll talk more about that a little bit later in the presentation. We also have some literature that we will offer to you after the presentation as well for purchase, and then also there's some other life insurance information as well. But we have this blue book called the Saving Your Future book. Honestly, I recommend it to everybody. It's a great book. It's got a whole bunch of tips and tricks about life insurance, about annuities, about how to be smart with your money, how to save on your taxes. I've read the book a few times. Sandra has read it, I'm sure, several times now. And it's just a great resource. We also have the financial workshop book that goes with it. So whenever you get, the workshops are offered online. So if you ever tune in, there's places where you can fill in notes and things of that nature while you're going through the workshop. So these are all just great resources that you can have to really build your financial wealth and really educate yourself, and then also educate your families. So you can go to the next slide. So as being part of WSB, we're kind of a signature in what we do, in that we have access to a whole bunch of different providers, and it kind of makes us unique in that aspect. Whereas a lot of times when you meet with people for life insurance, they usually work for one specific provider or one specific company. But with WSB, we have access to all these different providers. So we have access to, a lot of the big names, Transamerica, Everest, Nationwide, AMS. So based on your needs, like if you have various different needs or whatever a family needs, like we would be the best person to be able to help you with that because we have access to so many. So just want to point that out there because we partner with a lot of different providers. So you can go to the next slide. All right, let's get into the presentation. So there are 3 rules of money, and I'm just going to go over one of those rules really quick. I actually didn't know about this rule until I met Sandra and came into contact with WSB. But there's this rule of 72, and it's a pretty simple rule to understand how your money works. So essentially, you will take the number 72 and divide it by the interest that you're getting on, say, an investment account. So for instance, if you had $10,000 and you put it into an account that you were getting an interest of 1%, and you were 29 years old, it's essentially going to take 72 years, 72 divided by 1, to double your money. So that's a pretty low interest rate. Oh, you need her to. Oh, can you zoom in a little bit? I'm sorry. But yeah, so essentially, it'll take 72 years to double your money. So essentially, what I'm trying to say here is you want to invest in something that's going to give you the highest return or the highest interest rate as possible. So then we've got another scenario where you are investing in something and you get a rate of return of 4%. So in 18 years, 72 divided by 4 is 18, you'll be able to double your money. So same scenario, you were 29, you put $10,000 in. By the time you're 47, you got $20,000. By the time you're 65, you got $40,000. Which at the end of the day, $40,000 by the age of 65 still isn't that great, especially if you want to retire. So again, you're wanting to find some type of vehicle or something that's going to allow you to be able to get or save as much money as possible by the time you want to retire. So if you go, Ariane, if you go all the way to the right, so say for instance, you're investing in something that gives you a rate of 12%. So essentially, it's only going to take 6 years for your money to double. So every 6 years, your money is going to double. So that $10,000 investment that you started with at the age of 29, by the time you're 65, has gone up to $640,000. So that's a lot better than the $40,000 in that previous scenario. So, and we're going to talk about stuff like that and more ways for you to protect your money and be able to, retire comfortably in the presentation as well. So you can go to the next slide. All right, another item that I work with my clients is ways for you to reduce the impact of taxes. So we all have to pay taxes. We all have to pay Uncle Sam, whether it be through sales tax. We got state tax in some places. I know they don't have it in Tennessee, but we've got that, and then you have your income tax as well. So there are essentially three buckets or 3 ways that you can be taxed. So the first bucket is tax now. So you have a savings account, a CD, a checkings account, that sort of thing. You're being taxed the income tax on your money. So, that's money that you get deposited into your account. They're taking those taxes out already. Then you have your tax later. So in this bucket, you've got like your 401k, your IRA, a fixed annuity. So those are things where you're not being taxed now as you're contributing to them, but if you were to withdraw any money, you're going to be taxed on it. And then also in some scenarios, say with your 401k, if you take out your money too early, then you'll get that tax penalty. So that's not a favorable bucket either. So then we move on to this tax advantage bucket, which is all the great stuff and the great vehicles where you're not taxed on the money that you put in here. And if it grows, you're still not taxed on it. So you've got like your Roth IRA, your municipal bonds, your executive bonus plan. So executive bonus plan is really a great tool if you're a business owner because it's a good way for you to pay yourself tax-free. And then also we've got the Index Universal Life tool, which we're going to go into. Sandra's going to go in depth about today, which is a life insurance tool that allows you have life insurance, but it also allows you to be able to fund money into something. And if you ever need to withdraw from it, you can withdraw tax-free. So there's no tax penalty or any taxes being taken out when you need that money. So you can go to the next slide. All right. So just again, just want to stress life insurance is very important. As it says here, life insurance doesn't insure just your life, it insures your family's ability to continue on without being financially devastated. And you can click, I think there's an image. So just want to stress again the importance of life insurance. I know it's not a great subject to always talk about, but you always want to leave something for your family. You want to leave something for, the generations after you so that they don't have to worry about anything. And it's really one of the key concepts of financial wealth. So again, with life insurance, you got income replacement. You're protecting your money by getting a life insurance policy. Or in the event that something happens to you, you want to have a fail-safe or a plan just in case, if you're the breadwinner of your family, you want to make sure that, there's something in place for your family so that they can be okay. Also, leaving an inheritance, like I said before, for your family and for generations to come as well. Also, if you have for trust planning, life insurance is very important. Then also, and we can get into this more later, but also long-term care as well. That's an option for the IUL plan that we're going over today. So you can go to the next one. So again, life insurance, it's part of the foundation of the financial house. And financial house is a key concept in, financial wealth. So a couple quotes here. Life insurance isn't a fun topic, as I said before, but it's a critical part of your financial strategy. You can purchase all kinds of insurance protection like house, cars, and even travel insurance, but life insurance is vital. So I think if you click again, there's also a graphic. So this is the financial house, or the building blocks of financial wealth, or what have you. So first you've got your protection, which is what we'll be talking about today. You want to protect your money in the event that, you have to go on disability or something happens to you. You want to make sure that you have something in place to protect you. Then after that, it's debt management. So you want to relinquish or get rid of any liabilities or any debt that you may have and reduce your liabilities as much as possible. Then after you've completed that, you want to have an emergency fund. You want to have 3 to 6 months of your income kept away in the event that, something comes up or you have to take care of something, or if you, are laid off from your job and you need some income while you're looking for a new job. And then after all of those have been built, then you have your money for investment. So that's where you can, invest in certain things, invest in an annuity or a Roth IRA or whatever, and allow your money to grow so that all these things put together allow you to live in financial freedom. So with all of that, I'm going to switch gears here. I want to introduce my business partner, Sandra Williamson. We actually met about 2 years ago. I started out as a client, and she started out helping me with my finances and brought up the topic we'll talk about today, the IUL. And so I personally have an IUL, and it's honestly been a great tool for me. And we've also talked about, other ways that I can budget and save. And honestly, it's been just a great relationship. And it's grown into now this business partnership. And so now we partner together in helping families. And so she's really been a great resource. She's met a lot of my family, and we've been, providing help and solutions for them as well. So I want to, without further ado, bring up my great business partner and friend, Sandra Williamson.
Well, thank you. Can you guys hear me okay? Yes. All right. Thank you, Ivan. Didn't he do an amazing job? Awesome. Thank you, Ivan. Just stay close, right? Okay. I was going to say, where's my glasses? They're on my face. When you pass 40, your eyes start playing tricks on you. Amen? All right. Hey, Pastor. Thank you. I want to first give thanks to my almighty God for just being here. I'm not here without him. And then also want to, give honor to the pastor of this church and his beautiful wife, to Mama Lee back there. How are you? Thank you again for letting me borrow your son every now and then. But welcome to all the guests here. We do not take your time lightly. I do want to give a shout out to our other partner, Vicky. She drove with me to come and, just be of a servant, because this is what we do. We serve our community, and this is what I love to do. So I'm just going to go into the different types of life insurance. Ariana, you can bring the slides up. So when you think about life insurance, a lot of times we are privy to term and whole life, right? We know of those terms, right? But there's 5 different types of life insurance that many consumers and families don't know about. And a lot of these insurance plans can really allow you to do some amazing things in your finances. And this is why we have this National Awareness Month. As a mom of 6, I'm a mom of 6. My oldest is 29. I have twins that are 10 years old. I retired myself from corporate America 11 years ago when I was realizing I was having twins. I told my husband, yep, that's my retirement package. So I left, born and raised in Chicago, and I've been in the corporate sector about 23 years. And from there, I run and operate a financial consulting firm with my husband. And we do some business overseas. So that's a little bit about me. This campaign found me like I found Ivan. So I wasn't looking, but it educated me, and it allowed me to be a better money manager. We trust a lot of people with our money. We trust our jobs with our 401ks. We have no control over that. But we have to begin to know that we have our best interest at heart, especially when it comes to our money. Would you agree? So we must begin to know basic principles about money. But this is just one aspect. If I do a good job, Pastor Taylor and Mrs. Taylor said I can come back and I can share a little bit more, but we're going to talk about life insurance. So as you look on the screen, you have 5 types, right? You have term, you have variable universal, you have whole life, you have term life, and you have index universal life. So we're going to just quickly talk through these. We can do one-on-ones, but if I do go too fast, I'm just doing it because of time permits, okay? So next slide, Ariana, thank you. And let's give it up for Ariana, our MC, tech, all of that. Thank you so much. We appreciate you. So I want to first highlight, guys, life insurance was not just invented 10 years ago. Life insurance has been around before we were around, right? And that's what we have to understand. It's the first building block to everyone's foundation, not just our homes, but businesses. So we wanted to highlight that businesses own life insurance. Without life insurance, they cannot function. They cannot run their operation. So I like to highlight that these are some of the banks that we know about, right? Bank of America, $19 billion. And this was as of 2016, so this is still outdated a little bit. Then you have what? Wells Fargo, $17 billion. JP Morgan Chase, $10 billion. U.S. Bank, $5 billion. So if they should have it, or if they have it, shouldn't we have it? It has to be something good about why do they have so much of it, right? So we have to be more aware of the importance of why life insurance is here. Next slide, Ariana. So now I want to give you just some things as to why they have it, because these pertain to us, family. This is not just for the wealthy, right? This is not a wealthy tip. This is just a lack of education tip. We're just not privy to these things because we work, right? We work every day. Every day we get up, we brush our teeth, we wash our face, we get our hair together, we out the door. We in our car for an hour based on traffic, right? And then what? We go to work for 8 hours, we come home, we sit back in traffic, we make dinner, and we out. Click, we 30. Click, we 50. Click, we 60, and we broke. That's what happens because we're not trying to understand our money. So here's why life insurance is so important with companies. Number one, it says it increases their financial stability. So why can't it increase ours? It reduced their taxes. It's a tax vehicle. That's why they use it. It also says it helps fund employee pensions. So as a nurse, we have a lot of medical professionals in the building, but we have to understand this is how healthcare is paid for. This is how your bonuses at your jobs are paid for. This is how pensions are paid for. They have already put these things in place. Cash value plays a huge role, and I'm going to show you that. And then the next one, have you ever heard of BOLI and COLI? That's bank-owned life insurance. So when we bring our monies to the bank takes our money, and they go lend our money back out to you, and they charge you interest on your own money. And that's by way of credit card, loan, personal loan. Am I right? And we don't know that. They just recycle our money to make money. And then you have COLI, corporate owned. Companies don't have that much money. Because what? The turnover in companies is always relevant. They're always in and out, but this is how they fund our bonuses. If you are high level, this is how they fund, again, our healthcare plans. Okay? So I wanted to highlight this because we have to understand life insurance is not just a word. It's a powerful vehicle. Okay, next slide. All right, so when you look at waiting for tech. All right, so some of the top reasons for owning life insurance, right? I like to highlight this because they say that paying off a burial, 84% of families have life insurance just for burial. They just want to be laid to rest. They don't want to burden their families with all of that. It says 64% want to use it as a transfer of wealth. They want to leave it for the fourth, because the Bible say what? 4 generations deep, right? Then it says what? Replace loss of wages. 62% have life insurance for that purpose. Then supplementing income. How many are in retirement right now? Right? In retirement. This is a supplemental income for you guys. And then paying off the mortgage. Right? When we leave here, we still have what? Debt. The bill collectors don't care. They still want their money. People don't understand when you leave here, they're still coming after your assets. Next slide, Ariana. So now, do I really need life insurance, right? So let's look at who needs life insurance. Everybody. But here are some of the reasons we feel who needs it. Because a lot of times, even young adults, oh, I'm too young. I don't need life insurance. Why I need that? Or a housewife. But it says breadwinners. You have to replace your income. Actually, you can bring them up. Yeah, what does it say? Stay-at-home parents. I was a stay-at-home parent for 5 years before I couldn't do it anymore. But can nobody replace us, right, moms? If we left here, the dads or the fathers, they would be lost. So our income, it matters, because they may have to pay somebody to replace us. Is that true? Because family can only do so much, right? So that's important. Divorced parents, parents of special need children. These are critical. Homeowners, someone who co-signed a debt. A lot of times as parents, we co-sign for our kids. Is that true? And they leave us with this debt? Amen? Right? But we have to understand that if God forbid, that God called my child home, I'm stuck with this debt. So I need to protect Ivan Lee. Because mom has a lot, that's the importance of it. Then we look at a single person, high net worth individuals, someone who wants to provide an inheritance, business owners. This was key for me. So if you know any business owners or you're looking to start a business, understand that we don't have an employer. We are the employer, and we the employee. So we have to pay ourselves. Under the umbrella of life insurance, we can do that, tax-free. Right? And then you have investors who have maxed out other retirement plans. This is the wealthy family. So there are certain vehicles they can't use because they make too much money. So the wealthy have to supplement other ways in which they can grow their wealth, and life insurance is one of them. Okay? Next slide, Ariana, thank you. So now, how much do you need? You can bring it all up, Ariana, thank you. So this is a question that we get asked all the time. I meet families every day. And a lot of times they say, well, Sandra, give me $50,000 worth. This is not like like you in the grocery store, you're wanting to make a deal. It's not that. Can I get $100,000 worth? No. There's a formula, right? There's a system that you have to consider in order to make that number. Because some people are underinsured. They don't have enough. And then you have some people that are overinsured. They have too much, which is not a bad problem. But then you have some that's just not insured at all. So, Ariana, if you can zoom in on that dime method. So when you look at that, we use what we call the dime method. And I encourage you, if you want to sit down, we can Zoom together because I am in Georgia with Ivan. But I use this with every family that I talk to when they're wanting to understand how much they need. So we use a formula called the dime. And dime is just D-I-M-E. That's your debt, your income, your mortgage, and any education. So you can do this at home yourself. You just calculate your debt. So if you make, in this illustration, $50,000 a year, we recommend securing your income for 10 years. So if you times 50 times 10, that's what, $500,000, correct? So your protection needs should be minimum $500,000. But then you want to consider your income because you want to replace that. That's why it says income replacement for 10 years. That's $500,000. And if you have a mortgage, you have to include your mortgage because the goal is to pay that off. God forbid you're not here. You don't want the government or the state to take your property, right? And then if you have children, so a lot of moms are still raising their kids. So we want them to consider, is education a goal of yours? So if it is, do you want to make sure that you put that in your assets? Yes, most parents do. So we just calculate the average tuition is $15,000 a year, assuming you have 2 kids for a 4-year college, right? So when you add all of that up, their protection need is $870,000. But you have families that only have 50, right? So if they left, that wouldn't even be enough to pay off the mortgage because the mortgage is $122,000. Does that make sense? So we have to consider, now if education is not in your formula, you can take it out. But you need to consider your debt, the income that you make today, and any mortgage if you have mortgage. And even sometimes if you rent. But this is the formula that we use and we like to convey. Let me ask you a question. When we drive our cars, can we go into the insurance car dealer place and say, I just bought this new Toyota. I paid $60,000 for it, but I only want $20,000 on it. It's not, they will look at you like you're crazy. With our homes, by law, we can't even close without showing them we have full coverage for that house. Is that true? They won't even let us have $100,000 and the house is worth $200,000. You have to cover the whole thing. Likewise with our life, with our money. We should be protected. We are our number one asset. Can't nobody replace us. So the least we can do is make sure we try to come to as close as that number to take care of our families. Okay, next slide, Ariana. I hope that was helpful. So the question is, I get this a lot. Am I insurable, Sandra? We have a lot of things going on in our bodies. When we're young, that's the time to get it. Lock yourself in when you can do 55 jumping jacks. But that's when you get it. But now today, even our kids are subject to illnesses. They're not exempt. So I share with parents, as soon as your child turns 14 days old or you have a social security number, call me. I am so serious. I tell it just like that. Call me. Because we have to get them locked in now while their health has no problems. Because when they're 6-week checkup, they can be diagnosed with anything. And this is why we say applying for life insurance, it can be intimidating. Most people are like, they got to do an exam. They got to come to my house. Why do they have to do that? Because the insurance company is taking a risk. So the healthier you are, the more likely they are to what? Insure you. So if we look at these, zoom out just a little bit, Ariana, it says most life insurance requires a medical exam, right? That's blood, that's urine. They look at your health records. They go back. They go all the way back to when you were a baby. They pull your entire health records to see the history of your health. And many people don't understand that. So I also like to point out that if your parents are or have been diagnosed with early Alzheimer's, dementia, things that are chronic, like they received this when they were 40, chances are with the insurance company that that's going to be you. Does that make sense? So if your mom passed away at heart failure at 46 and your dad died of a stroke at 52, the chances of you living a long life is slim to the insurance company. But we know we serve a what? Right, all right? So what I'm saying is, it's still critical that if you know that your family has a history of chronic situations, you want to move fast because that's considered as a factor, okay? And then it says, many people are not insurable or may not know it. The estimated 80 million Americans have one or more types of heart disease. right? And it says, buy life insurance as soon as you can, as I mentioned. Don't wait too long because you may have health issues that may be too late. And even our young adults, they're 22, they're 25, they're healthy. They do that exam. There's so many things wrong with their insides internally that they're not even aware of. So that's why life insurance, I always say, you could go to the next slide, Ariana, is the best exam you could ever get in life. They don't do the exam like your doctor would. They don't run your blood in 5 tests. They run everything. So, and it's free, it's complimentary. So if you want to know how healthy you are, maybe go apply for life insurance. It's free. And you take that report and you take it back to your doctor, and then you work on the things, right, that concerns you. But it's the best health exam you will ever get in life, right? Unfortunately. Some factors companies consider. Bring them up, Ariana. As I mentioned, you can zoom it in, but I've already mentioned some of these. Your age, right? We already mentioned that can affect your premium, because a lot of times when I meet with families and they're in their 40s, God forbid they're over 50, the numbers is astronomical. They're like, Sandra, there's no way. There's no way. So there are ways around all of that. It's just sitting down with the professional to really understand, right, what that looks like. And then it says, again, I mentioned health history, gender, women live longer than men. Amen. No, but the family health history, even if you have no current medical conditions, a family history and illness, as I mentioned, smoking, right? The health risk associated with smoking is big. Hobbies, if you scuba dive, if you fly an airplane, if you ride a motorcycle, that's considered your occupation. Obviously, as I mentioned, you're a roofer, you're a police officer, a firefighter. Those are obviously considered in the premium, meaning the money that you pay monthly. Okay? Next slide, Ariana. So it says, what is your current situation now? Right? So if you can zoom in on that. So it says only 59% of Americans have life insurance today, guys. 59. It says one problem is that 9 million households just have group life insurance, and that's usually not enough. So that's through our jobs. So all your employer is just term. That's it. I ask clients and I ask families, I say, when you got hired, did they send you your insurance packet? Did you sign anything when you were hired, when you completed your benefits? Traditionally, they don't, because they own your life insurance. You don't own it. You're not the owner of it, because when you leave, you no longer have it, right? And then we have to be careful, because in some cases with life insurance, I've worked in corporate America too long, there is a lot of dismemberment. So you have to lose an eye or an arm or a leg for them to pay out. This is real. So we have to be very careful when we say, oh, I'm protected on my job, I'm good. You got to know what you have. I say, call your HR, see if you can get something in the mail to you so you can really understand what you have. Because the likelihood of someone losing something when they die is very slim. Is that true? So we got to know what we have, okay? Next slide, Ariana. Thank you. Now, let's go into the difference, right? I'm going to move a little faster. So it says term versus whole. A lot of times I get this question, Sandra, I have a term and I'm covered. I'm good. And I say, how much do you pay a month? They're like, I pay $17. It's like, okay, I'm sure you have a term, but do you mind if I look over your documents, right? Because term is what it says. It provides coverage for a specific amount of time. So you only get 5, 10, 15, 20. It's a contract, right, on your life between you and the insurance company. It's affordable. So the beauty about term, and it's a great product, you get high protection for low premium, but it only covers you within that time frame. So if we have a 20-year term and we outlive that, then the chances are that term is going to be really high when we turn that next age, right? Only 2% of terms are paid out. 2% are paid out. That's it. Again, the premium, the cash value, there's no cash value in term. It's just, it doesn't benefit you, the insured, it benefits your loved one. God forbid you leave too soon. Okay? And then, again, the payout is tax-free. And again, as you can see, the guarantee, the benefit is guaranteed for that specific time. Now, if we go over to whole life provides, right, what it says, lifelong coverage. So that's why it's called your whole life. So it's permanent. You don't have to worry about renewing after 20 years, 30 years. The other benefit is it costs a little bit more because now you're paying for your whole life. Your premiums remain the same. Here's the thing with whole life. You cannot miss a payment. You don't have that flexibility to say, I can't afford it this month, so I'm going to pay it in 2 months. No. They give you a grace period. If you do not pay, your plan will lapse. But you have to play catch up now. You have to pay until you are 100 years old. It's your whole life. You cannot pay till you're 90, till you're 65. You pay your whole life. There are some whole life plans today where you can do like they have a 20 pay and they have a 10 pay. But most whole lives, till you're 100. After 100, if you still living, you stop paying. But the average person don't want to pay their whole life, right? So now, cash value is generated in a whole life plan. That cash value is a fixed interest rate that is only given by the insurance company. So you don't get to decide what interest you receive. So what happens is when you pay your premium, a portion goes to your cost to insure your life, and the other portion goes to your cash value. It's a cash value account. In whole life, the life insurance company does not have to pay you in your cash value. Some people may remember this as dividends. Some people receive dividend checks from their life insurance company today. And that's just saying the company did well for that year, and those customers who had that plan, they pay them some cash. But most people don't take the cash, they put it in their cash account. So you can use those premiums, that cash, to pay your premiums, if you choose to. Does that make sense? Okay. Now, when you look at it, payout happens when you pass away or when it matures. So in whole life, if once you turn 100, if you haven't died, they pay you out. So if you have a $100,000 whole life and you live to 101, they just pay you $100,000 because you've outlived the policy. Make sense? But the cash value, they keep. Let me say it again. The cash value is not yours in a whole life. So as you're building that to possibly, you may need a loan at some point in your life. You can access your cash value in your whole life plan and use that money to go do things, buy a car, fix the roof, whatever. They don't question what you need it for, but it is a real loan. So most loans in whole life is anywhere between 4 to 8%. It's like a regular loan. It compounds interest. So many people forget that they have a loan, Sister Taylor, First Lady Taylor, in the whole life. And that money, that interest account is what? It's building up. It's growing. So when they pass away, oftentimes they don't have a payout. Mama Lee, they don't have a payout. Why? Because they forgot to pay back that loan. And the plan then lapsed. And they forget. They don't remember that they have that. So that's why it's important to know the type of plan you have. Does that mean that's power? And education is everything. Because that may not be the plan for you. Right? You may say, well, I like that, but I don't like the fact that, So that's why you have to get the education. And then the benefits guarantee over your lifetime, and it's a tax-free death benefit. So when it's paid out to your family, they do not pay taxes. Uncle Sam don't send them any 1099 or anything like that. Okay? So now, next one is universal life. So we talked about term, whole life. The third one is universal. So universal is like the cousin to the whole life. The beauty with universal is it's flexible. So remember I said you had to pay till you're 100? With universal, you can miss a payment, you can pay 50, you can pay nothing, right? You can pay whenever you want. It's flexible premium, okay? Many people like that option in case they get into a bind. It still comes with cash value, but as you can see, the cost of coverage guaranteed is not to change. Most monthly costs similar to term. Rates and coverage guarantee regardless of the market or the interest rate. And their coverage lasts until 90, 95, or even, as you can see, till 121. But look at the non-guaranteed side, family. The cost of coverage not guaranteed and increase as you age. So remember, this is key. If you're going to decide when you want to pay, keep in mind that cost of insurance every year is going up. So that cost of insurance comes from your cash value. That's how it's paid. So if you're not paying into your cash at the right amount, your plan can lapse sooner than you think. And then now you're 65 and you receive a letter that your policy is lapsing in the next 2 years, and you call up the insurance company and you're like, I've been making my payments. Well, sister, so-and-so, you've been sporadically paying, so your cash value is not keeping up with the policy, so you have to now pay us $10,000 to keep this policy alive until you reach 100. So it can increase, and I've seen it happen so many times, right? So it's very tricky. It's a very tricky plan to have. It's a good, but again, it's very tricky, so you have to pay. But that flexibility is what get people, because they can pay, not pay this, you pay, okay? And then it says your investment values are dependent on the market. So again, the interest in your cash is not guaranteed, it's based off the market, and most policies are underfunded, as I mentioned before. The last, it says by the time the client reached their 80s, the policy becomes unaffordable. They can't even afford the premium because they want too much for it. Okay, so that's universal. Now, the last one, number 5, is index universal. So index universal is what Ivan has. It's like a flagship. It's a really powerful vehicle if you use it correctly. Okay, I personally own 13 of these because all of my kids, I have 6 children. I'm a grandmother of 1. I forgot to mention that. My grandbaby, as soon as my grandbaby turned 14, I got that Social Security number. I got it locked in. I don't play with that. So IULs is like this, as you can see in the illustration. You're the policy holder, okay? That's you, the number 1. Number 2, you pay your premium to who? The insurance company, right? Like everybody else. Number 3, the insurance company is now going to pay your cost, right? So your premiums, the first thing that's paid is the cost to protect your life, the insurance portion. Then, number 3, the rest goes where? To your cash value. So after you done paid your cost to insure your life, that's when the remaining portion goes to the cash where it's growing. And that's what you use for your retirement and all that good stuff, right? After you've paid your cash account into your cash value, the policyholder can what? Can withdraw money if enough interest has accumulated. So remember I mentioned in the whole life, if you take out a loan, they charge you 8%, 9%, all of that. In an IUL, the minimum in most cases with most providers, you pay not even 1% interest on your money, right? Now, the beauty is it's tax-free. So when you take your money out in IUL, it's tax-free money. Okay, you don't pay no taxes, there's no penalty, Uncle Sam is not looking for you. So as you withdraw that money, the policyholder can take out a loan if they choose to. So in an IUL, you have a choice to do a withdrawal where you don't pay yourself back, or you can do a loan where you recycle your own money and you pay yourself back. Does that make sense? Okay, so when you look at that, it's like a recycled wealth building machine. Okay, so you're protecting not only your money, but you're protecting your retirement, you're protecting your kids' college education. You can use an IUL to do a whole lot of amazing things. Next slide, Ariana. Now, when you look at an IUL, there's some really good features that I want to highlight. And IRS allows us to use certain tax codes, right, that they have, that the insurance providers use within each plan. So if you look at the IRS codes to support the IUL, if you look at 7702A, this is where families can use this to, again, a tax-free code where they can begin to put money tax-free. So if you have extra money and you want to supercharge your retirement, if you want to start a college fund for your child or your grandchild, you can consider an IUL because these monies can go into that account tax-free. The child cannot touch those funds until you release control of that cash account to them. Okay? So these are some of the codes that I highlight because in an IUL, you could protect your family and your health. You could protect your business. It protects you against any market loss. So if you're someone that says, Sandra, I do have some income, I do want to save for my grandchild, but I don't want to lose any money. I don't want to be at risk with the hard-earned money that I'm working for. In an IUL, you never lose money. That's the beauty about it as well. And then, again, as I mentioned, it saves against tax and the IRS, and again, against creditors. So many people don't know, if you're ever sued and someone's coming after you, you hit someone and they sue you, they can take your house, they can take your car, they can sue you for all your assets. Is that true? But under protection in your cash value, they cannot touch that money. So wealthy people use that tool a lot. So if they ever sue, they will never see that money. Okay? So I like to point that out. Next slide, Ariana, and then we're going. So now, in my closing, I did take the liberty to do some live illustrations. So for grandmas that may want to insure their child, or if you know your family have little kids. So we call this the $1 million baby. So if you want to show a mom how they can generate wealth, I'm so serious. If you want to show someone how they can generate wealth for their children, this is a really good tool to use. I recommend this vehicle. Let's see. You see at the end, at the top, right? The baby is 1. You see the age column? Number 1. You guys see it? Because you guys are going to be blown away with this. So this number 1, right? Now, I want to draw your attention to the accumulated value to the far right. So I don't know if there's a cursor, Ariana, but to the far right. Yeah, there we go. So I don't know if you can zoom in and still do that at the same time. Okay, so this mom, baby's 1 year old, made a decision to just invest in their child $100 a month for the first, how many years? 1, 2, 3, 4. 4 years, the first 4 years of his or her life. Grandma and mom, you can do it together. They put $100 away. At 4 years old, the baby has accumulated about $900 cash, okay? Now, mom or grandma said, let's increase that. So they increased that at age 5. You see where now they're paying $200 a month because the money is growing very well for the child. So they increased it to $200 a month. So at 5 years old, all the way until they turn what? 10. Till they turn 9 years old. 9 years old, okay? They stopped investing the $200. So at 9 years old, you guys see that? At age 9, they stopped investing and they switched it now to $10 a day. So now they're funding $300 a month. Okay, so they started with 100, then they moved to 200, now they started saving 300. You don't have to do this, but I'm showing you an illustration to show you how you can generate some serious money or some good money for your child. Now, at age 18, the child took out $6,000. You see that bar? That $6,000 there? They may needed that to buy a car. They may wanted to get some braces or, I don't know, they needed some money. They took out $6,000. They're still sitting at a cash value of $44,000 that they can access to the right. You see that next little bar over there to the right? Their cash value is at $44,000. Now, they're really excited about their money. So at 23, right, they're now probably starting college or already into college, right? They took out $7,000 until they reached the age of 30. This is tax-free money. They just took out $7,000 till they reached age 30. They took out a total of $62,000, as you can see the total there, right? How much access or how much cash do they still have remaining? $76,000 they can still use at a later time. They took out $62,000, but they still have $76,000 that they can access anytime. Now, they're really serious, so they continue. Now let's get into retirement. This child has now reached, next slide, Ariana. So we're going to blow this up. So now the child is 65 years old. So you see that box, age 65. They're ready to now collect money. At 65, they're sitting at $897,000 cash. So they're now ready to retire. At 65, they tell this IUL, pay me a salary of $45,000 every year for the rest of my life. So at 65, they've paid themselves $45,000 a year till they reached, go up, Ariana, till they reached how old? 95, I believe. 95. 95, they paid themselves 45. Now you can take more, but they took 45,000 a year. They've taken $1.4 million tax-free. But let me draw your attention, Mom and dads and grandmas. They only put in of their own money. Go back, Ariana, because I want to highlight this. Of their own money, at 65 when they stop. Take me to 65 when they stop. So at 65, they put in $107,000 of their own money. I'm sorry, 214. Is that 18? 218. So you see that at 65, you see that 218? You guys see that number, 218,000? You see, Mom back there looking on the bigger screen. But you see the two. So of their own money, from birth to 65, they've paid of their own money, 218,000. Okay, does that make sense? They paid into their plan. But when they turn 95, now go to 95, they've taken out $1.4 million. They put in 218, but they've taken 1.4 million for their life. And if they died, God forbid, at 95, just go over a little bit, Ariana. They have a wealth transfer to their children's children of 1.3 million that they can still pass on wealth to. So family, what I'm saying is life insurance is the building block. When you insure your kids, when you insure yourself, your wealth goes to your kids. When your kids have protection, that wealth goes to their kids. When their kids have protection, that wealth goes to their kids. The family would never see debt. A family would never have to experience debt with proper protection. That's why the wealthy don't have a problem. The kids are already paid college in full. Once they reach 18, they have their check. It's already in the trust. But if we could just catch on to paying, maybe sacrificing Starbucks. I know a lot of people like Starbucks. First Lady, I'm not pointing you out. But if not every day. That's all, just not every day, right, Ivan? But if we could sacrifice a toy, because our kids, they love toys, but if we can invest in their life, just think, Grandma, you may need this money. You can access this money. Anybody can. God, this can be a family-owned bank. My God, this can be a family-owned bank. So if someone needs help, problem paying their mortgage, go into the family bank and take the money tax-free. That's what the wealthy do. So my last illustration, I ran somebody that's 28 because I know we have a lot of young adults in the church, and I want them to see. That's why I wish they were here. Good. I want them to see how they can invest in their life tax-free and really build some wealth for themselves. Because I tell my kids, my money can only go so far. Amen. My money can only go so far, Grandma. But if you have sense enough to follow this wealth building tool here, we can all help each other. So I ran something for a 28-year-old, right? Because they work. They make good money. My kids make really good money. So if they wanted to put away $5 a day, that's $150 a month. $5 if you guys hear me on the streaming. At 28 years old, they did that until they turned 32, okay? If they wanted to increase that because they got a promotion on the job, right, moms, right, dads, right, grandmas? Because they make money, they get promotions, so the job is paying them more. So now they increased that to $10 a day, as you can see at 33. Now they're paying $36 a year. See that? That's $10 a day. So Ariana, go down. So if they paid that $10 a day, right? And when you get to the next, they're just going to pay that. They're just going to keep paying. Now they can access this money. At 57 years old, they have access to what? Over $200,000. 200 cash, right? Right there. $200,000 they have access to. And God forbid they passed away at 57, they have a wealth transfer to their families of over $600,000. Tax-free. But let's go down to their retirement. Now they're still funding, they're saving. They're like, Mom, okay, I get it now. I want to save. And I just did something as small as $10,000. Now, at 65 years old, they're sitting at $361,000. They can now do the same thing the baby did and say, pay me an income. And this wealth building machine will pay them. I just said, what if they just took $10,000? I just did something very conservative. All the way till they turn, go to the next slide, Ariana, all the way till they turn 90. If they did that, they still have access to $591,000. If they passed away, they're leaving their family $1 million or their children. So please help me understand why life insurance is not a topic of discussion and why we don't need to be more aware of what we can do. Right? Next slide, Ariana. So with all of that, I had this life insurance policy letter that I want to read out loud. It says, I am your life insurance policy. It says, you and I have similar purposes in this world. It is your job to provide food, clothing, shelter, schooling, medicine, and things for your loved ones. You do this while I lie in your safety deposit box. I have faith and trust in you. Out of your earnings will come the cost of my upkeep. At times, I may appear insignificant to you, but someday, who knows, you and I will change places. When you are laid to rest, I will come alive and do your job. I may provide food, clothing, shelter, schooling, medicine, and other things your family may need to continue, just as you were doing now. When your work and labor is done, mine will begin. Through me, your hands can carry on. Whenever you feel the price you're paying for my upkeep is burdensome, remember that I can do more for you and your family than you will ever do for me. Signed, your life insurance policy. How powerful is that? Right? We think it's so insignificant. We just put it in the safe box, put it in the box. That is your asset, right? Next slide, Ariana. And I just wanted to share, as Ivan mentioned, we have free workshops, family, free. These are all the things we touch on. They're complimentary. They're on Zoom. So if you want to learn more about what we just talked about, Ivan and I, we'll make sure you get that information. If you fill out the card, we'll send you the link. Your grandkids, your kids, anybody can log in. You've seen a live person like me. This is not pre-recorded. You can ask questions in the chat and get answers. Somebody will call you back and answer all of your questions, okay? There's a workbook. As Ivan mentioned, if you are or do want to bless your grandchild or anyone, we have those books in the back that you can take one home and get start learning. Next slide, Ariana. And as you can see, here is our calendar. So September is here. So we have 6 workshops, 1 through 6. So as you can see, today is, we have them on Saturdays. We don't highlight Saturday and Sunday because they're by invitation, those that want them, but we can still send you the link to register. But Monday through Friday, they are accessible 2 time zones, 2 p.m., that's Eastern my time, and 8 p.m. So those are the 2 times they are aired, okay? And then next slide, we just want to have you fill out the survey. Let us know how we can help you. If there's somebody you want us to talk to, Ivan and I are here. We're licensed. We're able to give you anything that you need to help you with your financial needs. And the last slide is just to thank everybody for coming and listening. I hope what we shared added some value or answered some of your questions to what you may have regarding life insurance. Ivan, do you have any closing remarks you want to add?
Not really. Thank you all for coming. Thank you to everyone that tuned in online. I really appreciate you taking the time out to come be with us. And so if anyone has any questions, please feel free to contact me. You can inbox me on Facebook or email me. Or if you see my mom around, you can get with her and get my information as well. But again, thank you, and we appreciate you.